you know all about us, why don't you introduce yourself to the team?
Alright guys, thanks Kevin for having me. Name's Arjun Dhingra. I think I've met pretty much everybody here. With All Western Mortgage here in the city. I'm originally from Nevada, which is where I got started in the mortgage industry. And our bank is ironically based out of there. But I've been in lending for 18 years. Came to the city 14 years ago to expand our company's operation. We work strictly with residential real estate, so 1 to 4 units. Our bank is a direct lender, so you're dealing directly with the source. We're not a broker, and we're not an institutional lender. And I'll explain a little bit more about that in the interview today as to what the differences are and how we stand out. But our niche, whether it's working with seasoned investors to first-time buyers, it's a very service and experience-oriented type of transaction when you deal with us. So that's how we like to present ourselves. We're not transactional in the sense that we do high volume. Our experience in dealing with clients is a lot more relationship-based. So we'll do lower volume, but we've got a long-running relationship with our clients, know each other well, treat them like family, and I think that's what's really helped serve us well in the last 18 years.
Arjun.
Yes.
Because, in this area, it's very competitive. Can you please let us know what your niches are and what kind of tools you have for us when it comes to clients to put them in the best position when it comes to putting an offer in?
Okay, yeah, no, great question. So it's twofold. So for clients, we really need to put them in the best possible position to win. And there's a lot of ways you can do that, which is doing your homework up front. Almost every lender talks about pre-underwriting clients and getting them as far approved as possible early in the stage before you even take them out looking at homes, or especially before you write an offer. So we do that exact same thing. 60%, I'd say, of the entire loan process is done up front before they've written an offer, ideally. And what that does is allow them to write obviously a shorter contract period or offer period. We're closing purchase transactions in 18 days or less for people that have been pre-underwritten, which gives them a bit of a leg up. We also package, which we're very big on those types of aesthetics, which I think is also a big brand of your company and why you guys are successful. But how the offer is presented, we have a pre-underwrite package that we present. It's not just a letter. It goes a lot further than that. It talks about myself, it talks about the bank, it gives testimonials from past clients and past other realtors that have used our products and used our services and how they've been able to succeed in the market. And it goes into really like an over-explanation or an over-disclosure of the buyer's approval, their debt ratios, their credit score. The more information that we can give, the better in this case, because the agent opposite you when you're presenting that offer and their clients that are reviewing this together are going to feel a lot more comfortable that this client has really been vetted. They've been put through the gauntlet in terms of the actual loan underwriting process, and they're going to be in the best possible position to perform, and that it's very legit, so to speak. But for you as agents, how we like to help is just offering value anywhere we can. That sounds simple and almost mundane, but it's really in the way of tools and resources. As I mentioned earlier, we're very relationship driven, so I like to meet with every single client. I know there's a lot of lenders, they just talk on the phone with clients, they get through it, they've never even seen that person other than maybe just the copy of their photo ID, which was needed for the loan underwriting package. I will make sure that at some point early in the process we meet face to face. There's a comfort level there. There's some commonality found in their experience and what they're wanting to do, because I've been there, I've bought, I've sold, I've won and I've lost, I've been killed on properties. 18 years you've kind of ridden through a few cycles in the market. I want to share that experience with them. It can be daunting and just know that I relate to them that way. Yeah, like I said, I think it's twofold. For the client experience, and then for you as the agent, we want to provide you guys with tools and resources, whether it's, tax breakdowns. I've got something actually that I brought with me I wanted to share with you guys.
Great.
I'll give you guys a couple, or you can just pass them that way. You guys can pass these this way. This is just a really simple flyer of what I can put together, which is more of an analysis for someone that's looking to buy versus renting, which is the $1 million question or the conundrum that most people are facing in the city. So at $1.5 million, which I just used as a sweet spot, whether that's a condo or for a home, if you look up in the top, then it came up, the software I used just came up with a comparable rent, and assuming about a 3% annual rent increase if it's not a rent-controlled building. So you see in year 1 what the rent was, and then all the way out through year 9, which is what this model will show. And if someone was buying at an average interest rate of say 4.25%, with taxes, insurance, what their actual monthly expense would be. If you look at that cash flow difference where the red box is, that's going to be the difference over 9 years of how much more they paid as an owner versus if they had maintained paying rent. So obviously that's, they see that and say, wow, I paid more. But these are what the caveats are to actually owning. And that is where those two nice green boxes with big numbers are writing below. The appreciation gain, which is factoring in a historical appreciation, value for San Francisco or rate, what this person would have gained in appreciation, and then also the amortization gain, which is how much they paid down. And then below that amortization gain, you'll see what the tax benefit is. This is the eye popper for a lot of people because they don't consider that or know. It's factoring just based on a general tax rate or an individual tax rate of 32%, which most people kind of fall in given the salaries, or the average salary of a joint household here in San Francisco. So when we look at that, and then we look at at the bottom there what the net gain in buying a home is over time, how much they're experiencing in appreciation, how much they paid down, what their tax benefit is, they can really see that this is probably one of the most powerful investments they'll make. And this is a way to conceptualize it. We've got other tools like this that can even be more simple that show just an appreciation record over a certain period of time, and I can cater it or customize it to whatever you're thinking. If you feel like this person really wants a thing in small windows of time, whether it's 3 or 5 years, we can do things just in those windows. If this is a long-term thinker and they're super conservative and they're thinking about their investment over 15, 20, 30 years, we can cater the table that way. So the tools that way are endless, but the point of all this is I want to be able to create things and tools like this that either you can share, that we can all share as a group with these clients to provide them more peace of mind, information, and comfort, as opposed to them just being caught up in, well, I've got to buy this thing, and what is it really going to do for me? It's a bit daunting. I'm sinking my life savings into it. It's going to cost me a lot. What if I lose my job? What if things happen? This is a real sound investment, probably the greatest one that they'll make in their lives. And I want to provide you with stuff that's going to back that up.
Yeah, that's awesome. So it sounds like you take a really personal, customized, holistic approach.
Yes,
to serving
absolutely.
borrowers.
Yep. Not just spitting out numbers and saying this is what your payment is. Do you want to buy it or not? We like to advise. I'm not in this transactionally. In 18 years having done it, I want to actually add. I feel like I bring something to the table in terms of experience. So I want to advise people on what this is going to do for them in the long run and the short run. And tools like this kind of help put that into light.
This is really rare this day and age that your lender is willing to meet with your buyer face to face.
It's great that you take the time, because I know we all are kind of limited with time.
You guys do it, so I feel it's just as important that we do it. I mean, you're with the client a lot, obviously, and creating that relationship and that bond. And I feel we need to do the same.
Okay, so you had mentioned you could close in 18 days. So on the realtor side, we like to know, as far as contingencies, how short can you do a loan and appraisal contingency if needed?
I think we strategically structure those with you based on the transaction. There's not just a general rule that we'll use because it varies from property to property. If I'm working with you as a buyer's agent and you feel there won't be an issue with this property appraising, and again, this comes in our interaction and how we want to apply that strategy, then we don't need to go in with it. And obviously, our side of it with the pre-underwrite, we're going to be in position to offer you the ability to waive that financing contingency and, of course, advise the client on what that means so that they're comfortable with it. There's always a way to protect them in these transactions. You guys know that, and we do as well, regardless of what they're going in with and what they're choosing to waive or keep. But as long as everyone's in the know that way, I think we can structure these things uniquely. But each one is going to vary.
Sure.
It just will vary property to property.
Okay. Can I ask that question in another way?
Yeah, absolutely.
So when I worked at Wells Fargo, there was a panel of appraisers that we were able to choose from, because I know that you can't actually talk to the appraiser yourself. Yeah. How has your experience been with the appraisers that you've worked with in San Francisco? Is there a panel that you choose from, or is it just a random selection?
So we have 2 appraisal management companies that we work with primarily. Underneath each of those are a slew of appraisers, if you want to call them the panels, that these orders get distributed out to. We've got familiarity with a good amount of them. If there's ever a new one that pops up, we tend to proceed cautiously, or even just ask that the order be redistributed, especially in the fast close, because we just don't want to take the time, or take the chance, I should say.
Yeah.
There is no time. Let's take the time. Yeah. So our experience with it has been positive. I mean, we're not feeling it the people that we're working with don't have a sense of this market, because that was the case, I think, originally when this switch happened, or this transition, is you get a lot of appraisers in the East Bay coming into San Francisco. Not that there's anything wrong with that, but they won't be familiar with property here, or vice versa.
Cool.
Yeah.
How about for underwriters? How connected to you are
So
with the underwriting?
I feel this is like one of the stronger niche, or I should say advantages that we have, or value propositions. Being a direct lender means that everything from originating, processing, underwriting, and funding is all done under the same roof. We don't outsource for any of it. So our bank, like I said, is based out of Las Vegas, so our underwriters are there. I have direct contact with them. My partners and my team have direct contact with them. So when you, as our partner or the client, is calling us, you're getting an answer directly from the source. It's not that I have to stop and make a phone call to the East Coast and find something and function as a middleman. So we have familiarity, we've got a relationship with our underwriters. We kind of know which ones are bigger sticklers than others, which ones are more detail-oriented, or what irks some over others. So we kind of know how to push the buttons, without breaking any rules or laws.
Yeah. So you would say make sense underwriting for the most part?
Say again, sorry?
The underwriting is like the make sense type of underwriting. It's nothing, usually don't see.
Yeah, I mean, even if there's things that come out, we're very oriented with dealing with challenges or whatever we need to do to actually make the deal go through. Sometimes it's a restructuring, sometimes it's just traveling down a different lane. So things do pop up. For anyone to say that underwriting is a smooth process all the way through, I like to relate it to people. I tell this joke. I like to tell people it's literally like if you went through open heart surgery. You were under anesthesia. You have no idea how many times you may have died or how many times it was touch and go. All you know is that you woke up at the end in the recovery room, your doctor's there, your family's there, and everything is all good. So behind the scenes with underwriting, there's a lot of things that come up. Deals die, like it can be dead in the morning or like stopped, suspended. We're not going to let people panic. You're under anesthesia. We're working on this, we've got it. 2 hours later, everything is back up and we're good. We just had to restructure something, or there was something in it that wasn't necessary, or it was missing, whatever it might be. But I think underwriting is different all the time, and it's never smooth sailing. We like people on the outside to feel that it is, but I'm telling you, like as an honest, as an honest person on the inside of it, it's always bumpy that way. But we're experienced in dealing with it, and we just push and push until it gets done.
Sure, I always tell my clients that there's this is what you see here,
Right.
But really there's a ton of people. There's a ton of people that work on your loan. There's just like about, as soon as it starts, there's about 20 people really handling it in the background.
A lot of touch points.
There's a lot of work.
Yep.
That's an enhanced metaphor.
I feel like it applies though.
It really does.
It can't happen that way.
Yeah.
I mean, you were
That
under
is a
anesthesia. You
metaphor.
just don't know. You don't know what was really happening. All you know is you woke up and it was all good.
I always have a lot of questions, so
Yeah, all good.
As far as your loan products,
Mm-hmm.
I would say who can you client? Who can you cater to as far as like first-time home buyer, FHA, VA?
Yep.
What other types?
Okay, so we do that. We are HUD licensed and approved. We do a lot of VA and FHA loans. They're not predominant in this market, but we lend in 13 states. So in other states and other markets, some of those loan products are a little bit more prevalent. In this market, I would say, obviously being a jumbo loan market, we're doing a lot of that type of financing. But one niche that I feel right now in working with first-time home buyers is the 90% jumbo. Like someone who's only got 10% put down on a jumbo loan, but still able to get financed. Because the old way of thinking, or maybe the standard rule out there that everyone follows or they hear, is that you must put down 20% or 25%. And if you don't have those funds, you've got to wait to save, or try and pull in gift money, which you can. Of course, those are more ideal loans, but there are great products where if you're putting down just 10% or even 15%, that you can still qualify for jumbo financing at $2 million, sometimes a hair above that if need be, and you get into the market finally. You can break in and allow the market appreciation and some of the tax benefits to catch up and make up some of that indifference for you in the way of down payment. That's something we've done a lot of, I think, this year, I would say. I mean, just in the 6 months of this year, we've done more 10% down jumbo loans than any other type of product.
Does that come with PMI?
It doesn't. It's factored into the actual interest rate. So it's really tax advantage that way, because PMI, obviously being a line item, there's no benefit to carrying it. It's almost like a penalty, But sometimes it's the price for admission to getting into the market. This fly loves me.
I know.
Yeah.
It's like,
If I got this kind of affection, but I lost my train of thought.
No,
So
I
we
mean,
were
that's
talking
excellent.
90%. Yeah, and getting So I mean, it's
No PMI, so you can
no
write off
PMI.
more.
It's factored into the rate. So the rate will be a little bit higher, but in many cases, when we do a comparison of that, what's called an LPMI loan, where it's factored into the rate versus a lower rate with itemized PNI, this payment's actually cheaper. And given that it's factored in the interest rate, there's more to deduct there.
That's good to know.
Yeah.
for that 90% jumbo loan, is there a funny requirement in the back end? Like, do you have to carry $1 million with your bank as an asset or something like that?
Generally, 6 to 12 months reserves, which is standard on most loans anyway, is needed. If the credit scores are lower, they may require it, which is kind of almost oxymoronic. It doesn't make sense, but that's just the guideline. Retirement funds can be pulled in that way. We try and use some resources of, pulling in some gift money from a parent, to help cover the down payment so that you leave the assets you have in the bank alone to meet the reserve requirement. So it's kind of a balancing act or a bit of an equation, but there's always some ways to do it. So they're not unreasonable.
Nice.
They're really not unreasonable.
Okay, well, and everybody has a rate question. So how would you say your rates compare?
I think when it comes to interest rates in the market, almost everyone's in somewhat of a level playing field here. I mean, so on any given day, based on how sensitive banks are to the market and what's going on, some are adjusting a few times a day, some hold for the day and then wait to adjust the next day, some hold for the entire week. So all of them are different, but in this plane, up and down an eighth of a point or a quarter of a point is what you'll find amongst all lenders. Really what it comes down to, I mean, if somebody calls me and says, I only need to shop the best rate, I tell them, well, that search you could continue on all the way up until the day you have to remove your financing contingency, because there'll always be a lender with a lower rate. You can keep finding it. But you're sacrificing something. One, you're sacrificing time in that search, and you may actually be sacrificing some service. Online lenders such as Quicken, which is probably the most notorious in the space, their rates will generally, any day of the week, beat anyone else's rates. But you're dealing with a 1-800 loan officer that you can only reach during certain business hours. You're not going to catch them over the weekend. There's no advisement there. They're basically following scripts and matrices to put the deal through, which is why that bank can lower their margins and offer lower interest rates to that market share. So with us, it's going to be a little bit more of a package situation. You're getting a lot of experience, a lot of backing, a lot of support, a lot of creativity, guidance. But I never tell people that we have the lowest rates in town because it's just false.
Sure.
I mean, are they competitive? Absolutely. Are they in your best interest? Absolutely. Are they the lowest? No. You could search that and each day you find a lower and just keep shopping it, but you'll eventually run out of time, or the deal may not even close, so the rate's no good to you then.
Or when we're negotiating at 8 or 9 p.m. and they're debating between our client and someone else, and we can call you and you'd be available to bet on our.
For the partners I work with and the teams that I collaborate with, and there's a lot of people in our industry that advise against this, but I make myself open and available to my partners at all times. My wife hates it, but we've only just been married a few months, so she'll get used to it. She's like, why do you have to take a call at 9 p.m.? I'm like, this is important. I mean, they want this house, and it's the first one they're buying. This is a big deal for them. But she doesn't get that yet. She'll catch on.
She'll come around.
She'll come around.
I think it's hard for any spouses.
Yes, it is. It's a balancing act. Yeah.
So I have two questions.
Yes.
One has to, well, they both have to do with rates, but how does your bank handle if there is a rate adjustment during escrow?
Yes, great
so
question.
If it goes up, I know you're locked in, you're all good, but then if there's a correction and interest rates drop 0.5%,
yes.
how does your bank?
Which is a dramatic drop. I mean, that would be like something amazing
or
going on in the
even
market.
a quarter sometimes.
So the quarter is the sweet spot. I'm glad you said it.
Okay.
So and it's a great question because a lot of people feel like I don't want to commit now. It's kind of like leaving I use gambling analogy since I'm from Nevada. It's like getting off the craps table too soon when the table's still hot and you could have made more money. But in the case where we've locked an interest rate, if the rates drop an eighth isn't enough for us to be able to float down because an eighth can happen in a matter of an hour. However, 0.25%, if there has been a 0.25% drop during the point of the transaction, almost all the investors we deal with, which is over 30 of them, investors meaning places we sell loans or place them with, will allow us to float down the rate at no cost or any impact of the transaction.
Nice.
But conversely, we're at least covered that if rates were to take off, we're at least locked in.
Yep.
Yeah. And market activity does happen. I mean, things are volatile right now, so movement of 1/8 or 1/4% within a week, which is something that actually happened last week between Monday and Friday, it does happen. It's nice to be able to offer that.
My second question is,
Yeah.
I won't hold you to this, but what do you think interest rates are going to do later this year?
So we joke about this in the group that Kevin and I are part of it, because there's a few different lenders that work in different spaces, and we always have bets running. But I've been in the camp that rates weren't going to spike up as much as everyone thinks, or everyone's been weary of. Now, the Fed raising interest rates is very different from mortgage interest rates. Those are two separate spaces. The Fed is going to continue to do what they need to do because they have to put some controls on the economy and temper things. However, mortgage interest rates, I don't feel are going to break anywhere higher than they are kind of necessarily now. We're at about a 7-year high right now, considering where they were. But with all the chaos that's going on in the world, they're kind of scaling back a bit. And I tell people, you want to pray for chaos if you want lower rates. Anytime there's bad news, and sometimes unfortunate news, whether it's in the way of like overseas terrorist attacks, shakeups in the market, gas prices going high, anything that's negative to you as a consumer is actually really good for interest rates. And there's always stuff like that happening. There's always chaotic stuff. I mean, just turn on the news.
Let's
It's crazy.
something bad happened, lock my loan.
Yeah. So I mean, when things are negative,
Yeah.
it tends to have a positive effect on interest rates, meaning bringing them down. And when the economy is ripping and roaring and everything is positive and sunshine and rainbows, rates tend to go up. But I think there's enough noise out there that's going to keep rates kind of in the space that they're in. So you can hold me to it. I don't think they're actually going to go a heck of a lot higher than they are now. There won't be this continued spike all the way through the end of 2018.
That's good.
That's where my money is. Yeah.
Any underwriting changes that you expect?
I think now that there were some provisions of Dodd-Frank that were just rolled back last week, the president signed that into law. And Dodd-Frank was the big regulatory reform bill that came forth in the wake of the housing crash. It put a lot of, in my honest opinion, it kind of over-controlled a lot of spaces for lending because the law was written by people that know nothing about lending, such as government in the United States. We won't get into that. And now that some of that is rolling back, it's going to release some controls. I don't think it's going to necessarily drastically improve underwriting standards to the point that they were when things were very loosey-goosey. But I think some banks will loosen some of their requirements. We're already seeing that coming down from some investors. Even just the insertion of this 90% jumbo product. A few years ago, that was completely unheard of. You had to absolutely have 20, in some cases 25% down to qualify for a jumbo loan. So just seeing that and seeing that trend of more creativity coming into the market and what are considered non-prime loans, I think is a good sign for the market moving forward because there's always a space for those products.
Let's backtrack a little bit.
Yeah.
For the lay people, our viewers at home, you mentioned that you do all your processing, underwriting, and funding in-house.
Yep.
Why is that important to borrow to our clients?
I think for control, right? I mean, people joke, in our industry they joke, they say the biggest control freaks are real estate agents. So we always say that. The real estate agents are all control freaks, they want to know where everything is. And I think in understanding that, or appreciating that, because that's a good thing, when you want to guide the transaction and keep it on track, from a lending standpoint, that's really important when you can deal with something that every facet of that process is happening in-house or in one spot. So you as a partner, and then in relaying information to your clients, anything you need in the way of information is, again, coming directly from the source, which means we're held accountable for that. But it just, for speed, for ease of transaction, for even cost, it keeps cost way down in in having everything being done under one roof. All of which is positive to a transaction, to a client experience.
So when our clients are looking for a timeline and need to know when their closing disclosure is going to go out and they can actually close escrow and get keys to their home, you mean you'll actually have an answer for us?
Yes. Yes. We would like to, yes. I think that's important for everyone, right?
And if the loan processors ask for additional documentation in the 11th hour, you'll actually be able to figure out why they're asking for it and possibly get an exception.
Yes. And nothing that's going to come at the sake, unless it's absolutely dire, if it was something that popped up, and there's some examples that I can give, but unless it's absolutely dire, it's nothing that's going to jeopardize the timing. We can move those conditions to the point where they're going to be dealt with or checked off at funding time, as opposed to holding up a signing or holding up a CD going on. Those key benchmarks in the transaction, you guys know better than we do, are just uber important to keeping everything moving along and also keeping the seller side of the transaction at bay and calm that things are moving according to timeline and not creating panic. So yes, anything like that, even if it pops up, which of course it happens, we want to be able to push it off or deal with it in a way that it's not holding up things, but it can happen concurrently.
This is so important, guys, and that's why we work with lenders like Arjun. It can really leave a bad taste in the mouths of our clients if they have an amazing experience with us, but things start moving sideways during the escrow and we can't get any answers. So that's one of the reasons we appreciate you, Arjun.
Thanks, brother. Appreciate it, man.
Yeah. Are there any other? Is there anything else about All Western Mortgage that you want to point out? Things that you do differently or perhaps better than other banks?
I think just identifying what we are and how we're different than other banks is important in a general sense. So I explain this just almost in a simple illustration that you've got mortgage brokers and you've got institutional lenders. You're on the far right end of the spectrum. These are your Wells Fargo's, Chase, Citibank, large banks that you can walk into and deal with retail. You're dealing with their products and everything is done by them, even though a lot of their underwriting is done regionally, so generally in a different time zone, which can slow the process down a bit, but it's all done, everything is done with this one source. Downside, or not even a downside to it because they're all very competitive, but you're dealing just with their products and you need to fit in their box. So those are their caveats. Brokers, which have basically their main niche or their value proposition was that they were able to offer choice, which can sometimes bring costs down. I'll find you the best rated product because they deal with a lot of these banks on this side. So if they've got 5 that they can shop your profile with, they'll find a way to get you the best possible competitive rate and package so that your loan can go through a lot easier. This side of the business, in the wake of a lot of the regulations, has been squeezed and pinched a bit in the sense that there's fewer large banks that want to do that kind of business. It's called wholesale. We sit right in the middle, so we have the best of both worlds as a correspondent bank. So as I mentioned, over and over again, we do everything in-house. We use our own money to lend, and then we sell loans to about 30 different investors. So we have the best of both worlds in the sense that we have choice with 30 investors we can sell to, but we also, just like the big banks, we do everything in-house, and it's a one-stop shop that way. So that's where we kind of create some separation. There's a lot of banks in this model, many lenders that work as a correspondent or a direct lender, but I think there are advantages in real estate transaction, lots of advantages, to dealing directly with a lender because of some of those caveats I mentioned in terms of process, price, and speed.
We're going to see a lot less pure mortgage brokers moving forward and a lot more correspondent lenders. And I think All Western Mortgage was one of the first direct lenders. So you guys have been around for how many years?
The bank's been around over 30 years.
30 years.
We've been in this market here for 14, almost 15 years.
Since you came to San Francisco.
Since I came to San Francisco.
Hi there.
Yeah, it's a great place. Changed a lot, like you pointed out.
Yeah.
Having grown up
Right?
here, yes. Not the same place.
So as a direct lender, we sell a lot of new construction condos.
Mm-hmm.
So you can piggyback on Bank of America's approval, Chase's approval.
Right.
Yeah.
Yeah, because a lot of those banks we sell to. So if they have a project approval initially, or depending on what their pre-sale requirements are, and obviously everyone's a little bit different, we do have some investors as well, kind of as a second look lender. We like to consider ourselves on those projects that don't have as high of a pre-sale requirement, or they're going to have products with where if someone's got a certain criteria or factor that's outside the box, whether it's credit or reserves or down payment, to where they'll allow that. Whereas a lot of the larger banks want a certain amount of exposure, and then that's it. They're going to cap it at that. They don't want to be overexposed on a certain high rise or a new project.
So a buyer would have a lot more options with you, especially if they're considering both resale and new construction. Because if they just go to, let's say, Chase and they've been banking with Chase, they have all Chase products, but Chase isn't a preferred lender on a new construction building.
Right.
If they work with you from the beginning, then they would still have the choice.
Absolutely. It's definitely a possibility. I mean, we still have to go through certain protocols of internally approving the project and seeing where it's at. But yes, once we've cleared that hurdle, yeah, absolutely, there would be a lot more choice and range of options. Yep. Question?
We have one last question.
We're going to ask you a personal question.
Yes.
All right.
Okay, Kevin left.
As you can see, we definitely appreciate the value of a team. You actually coach Team USA, the Taekwondo national team.
Yeah.
And you're a 2-time gold medalist yourself. So, how is
homework?
how cool is that?
Stalking me online.
So, how do you think your experience as a competitive athlete has translated into the business world? How has that helped you as a mortgage maker?
I think just the overall competitive nature that I have and personality, and we shared a bit of this at an event a while back, and just wanting to win and being a bit of an extrovert and loving people, all different kinds of people. I want them to win. So, and that's really what my role is now as a coach. I don't compete anymore. I want my guys to win. I want to pour everything I can in them to help them succeed. And I do, to a fault, I do that with my clients, where I get really emotionally attached to this transaction that they're doing. I'm just as invested as they are, even in the stress levels, because I want to see them. I want to see them break through. I want to see them get in. I want to see them win. And that's why I really enjoy working with first-time homebuyers, because a lot of them have felt like underdogs in the market, so to speak. They're being priced out by cash buyers. They don't have enough to put down. They feel intimidated. They're just confused by the process, whatever it might be. So those are the people I love to team up with and say, we can do this, we will do this, you're going to do it, and we push them through. And there's nothing more satisfying than when someone who is struck out, maybe in a few offers, and then they come along and get paired up with me, and whether it's the first one or definitely by the second one, we break through and we get them in. It's a good feeling.
Yeah, I get that. Thanks, Coach.
Yeah.
Arjun.
Thanks for having me, brother.
Bring home the gold. Bring home the gold for all our clients for the past 3 years now. Thank you.
Thanks, man.